Tax time can be an exceptionally tricky time for investors. You've got buys, sells, capital gains, losses, dividend distributions, cost-based adjustments. The list goes on. What starts off as a straightforward way to snowball your wealth turns into a logistical nightmare. All the meanwhile, the ATO is just waiting for you to mess up. But it doesn't have to be this way. The trick is you need to understand the 5 key things you have to track. So in this video, let's talk through exactly that. And by the end, you'll know how to tax-proof your investment portfolio and make tax reporting season simple and painless. Most investors think tracking buys and sells is simple. It's just what I bought, what I sold, and the difference. But here's the part nobody finds out until tax time. Your broker only shows you basic gains and losses. The ATO requires tax calculations, and they aren't the same thing. And the difference between those two is where people get into big trouble. The ATO expects capital gains to be calculated parcel by parcel, not by averages, not by whatever your broker displays. So if you sell 10 units, they want to know which exact 10 units, from what date, what cost base, with what fees attached. And to do that correctly, you need exact buy dates, exact quantities, exact buy prices, exact brokerage, and exact parcel selection for every disposal. If any of those are missing, your CGT is wrong before you even start. And here's the part that surprises most investors. Brokers aren't actually tracking tax for you. They just track trades. That's it. They don't match parcels. They don't adjust cost bases. They don't track tax deferred components. They definitely don't apply AMIT changes or handle DRPs or create CGT reports the ATO expects you to use. So people show up at tax time with a trade export thinking they're finished. But that export doesn't contain any of the tax information you actually need. And if you think tracking buys and sells is detailed, wait until you look inside your ETF distributions. Dividends are simple. ETF distributions are not. This is the part of tax time where most investors get blindsided because ETF distributions contain things your broker doesn't explain, and your tax return absolutely depends on. Most investors think a distribution is just cash paid to me. But what actually gets reported to the ATO is a breakdown of components that can change your tax and even your cost base. So inside an ETF distribution, you've got things like franking credits, foreign income, capital gains generated inside the fund, tax deferred amounts, you've got AMIT cost-based adjustments, they're a big one. And here's the part nobody tells you. The cash you receive is rarely the number you get taxed on, and that's where the confusion begins. You'll get a distribution from an ETF in, say, July or October, but the annual tax statement that explains the breakdown comes months later. This comes after the end of financial year. So people file returns with the wrong numbers, not on purpose, but because they didn't have the final statement yet. And then there's cost-based adjustments. These adjust your cost base every single year, sometimes up and sometimes down. And if you don't track these adjustments, your cost base becomes wrong. Not for just that year, but forever. Every future CGT calculation becomes inaccurate from that point on. And investors usually don't realize until they sell and wonder why their capital gain looks way larger than expected. And distributions are just one layer. The next layer, corporate actions, can rewrite your cost base overnight. Corporate actions can be silent investment tax killers. These are the things that quietly rewrite your cost base without you actually touching anything. And this is the category almost no investor tracks, and it's the one that creates the biggest tax mistakes. Because corporate actions include things like DRPs, splits, consolidations, mergers, demergers, off-market buybacks, return of capital payments, fund restructures, the list goes on. And most investors see these and think, yeah, whatever, the units changed, the price changed, all good. But it's not all good. Every one of these events can and usually does change your cost base, sometimes slightly, sometimes drastically. DRP, new units, new parcel, new cost base. A split or consolidation, quantities shift, cost per unit changes. A buyback, part income, part capital, part cost-based adjustment. A demerger, your original cost base now gets split across multiple holdings. A return of capital, your cost base decreases, meaning a larger gain when you eventually sell. And if you don't track these events, your cost base stops being accurate from that day forward. Every sale after that, wrong. Every gain, wrong. Every loss, wrong. And you may not notice for years until the numbers no longer make sense at tax time. Corporate actions don't ask for permission. You don't have to do anything. They just happen. and you're required to track them. And the wild part is corporate actions aren't even the smallest thing that can throw your tax off. There's another layer investors almost never think about. These things can be a death by 1,000 cuts for your investments at tax time. After corporate actions, most people assume the big surprises are over. But there's a whole category of tiny adjustments that investors ignore because they seem insignificant until they aren't. These are the items that quietly change your tax position $1 at a time. Things like brokerage fees, or FX conversions, or crypto trading fees, or interest earned on cash holdings, borrowing expenses if you trade on margin, currency gains and losses from international investing. None of these feel important in the moment. A few dollars here, small percentage there, tiny FX spread you barely noticed. But tax isn't based on what feels important. It's based on what's accurate. Miss a brokerage fee? Your cost base is wrong. Trade in USD, you need the AUD value at the exact time of the trade, not the monthly average, not whatever your app displays. Use a platform that charges hidden FX spreads. Those spreads affect your acquisition cost. Make a little interest on your uninvested cash. That's taxable income. Did you borrow to invest? Those loan fees don't disappear. They have tax treatment too. And none of these are big by themselves, but they start to add up. And when you start selling, everything depends on these numbers being correct. Because at the end of all this, the buyers, sells, distributions, corporate actions, fees, foreign exchange, there's one calculation that brings everything together. And that's where most investors finally see whether they've been tracking correctly or not. This is the moment of truth for any investment portfolio at tax time. Capital gains is the moment where everything you've tracked or failed to track finally shows up. Because CGT isn't just bought at X, sold at Y. It's the sum of every decision, every distribution, every adjustment, every fee, every FX conversion, every corporate action that happened along the way. So when you sell something, you're not calculating one number, you're calculating the exact parcel or parcels you're disposed of, the true cost base of that parcel, every change made to that cost base over time, whether it's eligible for the CGT discount, and what losses you can apply against it. That's capital gains. So if any part of your data upstream is missing, a DRP, a distribution adjustment, a return of capital, a brokerage fee, an FX event, your CGT calculation is wrong before you even start. And here's the part most investors only discover when it's too late. Selling doesn't create the complexity. Selling reveals it. So if your portfolio has been tracked accurately, CGT is super straightforward. If it hasn't, you feel it immediately. The numbers don't match, the gains look bigger than expected, the tax is higher than it should be, and it becomes a puzzle with missing pieces. And this is why accountants say it's not the sale that's complicated, it's the history behind the sale. Capital gains is simply the final report card. Tells you whether everything before this point was tracked properly. If you have tracked everything up to this point, the buys, the sells, the distributions, the corporate actions, the small stuff, capital gains becomes super easy. If you haven't, this is where you feel it. So now you know how to tax-proof your investment portfolio because you know exactly what the ATO expects you to track. How you track it, spreadsheets, tools, whatever, is completely up to you. I might even have spent years building the perfect tool to automate every aspect of your tax reporting, but this isn't an ad. The important part is that you understand the tax system and stay consistent. If you want more videos on things like AMIT or DRPs or cost-based repairs, drop it in the comments and I'll chuck it on the list. Make sure you're subscribed and I'll see you in the next video.